Welcome to Lesson 5, Japanese Candlesticks. Our quote for this lesson comes from Sun Tzu, author of The Art of War, who said, "In the midst of chaos, there is also opportunity." And I thought this an appropriate quote for this lesson because when you first view a chart, it can look like just a whole bunch of chaos, okay? There is opportunity in that chaos. In fact, the more chaos there is, the more opportunity there is. It's all about understanding what it is that we're looking at, okay? The information that's presented to us. So we start by discussing the anatomy of a candle, okay? In this graphic, we have a decisive bullish candle on the left, and on the right we have a decisive bearish candle. Now, a candlestick just simply measures the price fluctuation over a period of time. Okay, so in other words, where did price go over a specific period of time? And if you're looking at a 15-minute chart, for example, then one candle represents 15 minutes worth of movement. So, where did the price go over that 15-minute period? And a candle is comprised of four components. It has an open, a close, a high, and a low. With a decisive bullish candle, our open is at the bottom, right? And that makes sense because if the bulls are, if the main goal of the bulls is to drive price higher, then it would make sense that the close of a bullish candle would be higher than the open, right? Hence why it's a bullish candle. If it's a bullish candle, it means that the bulls were successful in their objective, in driving price higher, okay? Now the high price just represents the highest price the market went to over that period of time. And similarly, the low price does the same thing, but obviously for the low. Okay, so the open price is where price began at the start of this period of time. The low price is the lowest that prices dipped over this period of time. The high is the highest prices rallied to over this period of time. And the close is where the market actually ended up by the end of this period of time. So again, if we're looking at a 15-minute time frame, for example, then over that 15-minute period of time, where did price begin? What's the lowest point it hit? What's the highest point it hit? And where did it end up after all, right? So when all was said and done and the market, or not the market, but the candle closed, so that period of time elapsed, where did it all end up? Okay, and that's what determines whether a candle is bullish or whether a candle is bearish. And again, a candlestick is just simply a measurement or a visual representation, I should say, of the price fluctuation over a specific period of time. Now, there are two types of candlesticks that we have, right? There are decisive candles and there are indecisive candles. Let's focus on the left-hand side of the screen first, okay? A decisive bullish candle is one in which the bulls were successful in their objective, as I said a moment ago, right? If the objective of the bulls is to drive price higher, and they succeed at doing so, then what's left behind is a decisive bullish candle, right? We can see a nice, healthy sized body of the candle. So we have our wicks, right, that are denoting our high and low here, and then we have our body, which is the difference between the open and the close over that set period of time. An indecisive bullish candle, with an indecisive bullish candle, the bulls were still successful in their objective of pushing prices higher. The difference here is that it is the degree to which they found success. So in other words, with a decisive bullish candle, bulls were able to push the price and close it significantly higher or substantially higher than where prices opened. With an indecisive bullish candle, okay, even though the bulls were still able to push price higher, a lot of resistance came in. The bears put up quite a fight. And so, you know, where prices ended up would not be, or is not, as significant a place as where they end up with decisive candles. Now, the same concept occurs with a bearish candle, okay? And again, you know, we have two types of candles here for the bears as well. We have a decisive bearish and an indecisive bearish. In both instances, just like with the bullish candles, in both instances here, the bears were successful in pushing prices lower than where they began. Because again, remember, if we go back for a moment to our anatomy of a candle here, okay, if a bullish candle opens here and closes here, right, then you can say that a decisive move to the upside occurred, right? Because the bulls were able to not only push prices higher, but close them higher. Well, with a bearish candle, all right, again, it's the opposite. So rather than pushing prices higher, the bears are looking to push prices lower. And so when we have our decisive bearish candle, right, it just means that the bears were more successful than they are with an indecisive candle. Okay, in other words, price was not only driven down, but it was, you know, driven down and closed at a lower price than where it began. Because remember, for bearish candles, you know, we're opening higher than we're closing. So our open price is up here at the top of the body, and our close price is down here at the bottom of the body. All right, and an indecisive bearish candle, again, just like with its bullish counterpart, and it's exactly the same concept, right? So the bears were still successful here in driving price lower. The difference is the degree of success that they've managed to achieve. Now, when we have candlesticks forming together, what happens is we get what's called formations. And formations are indicators, all right? They're naturally occurring indicators. In other words, you know, they're already there in the market. So it's not like we're adding an additional technical indicator to the chart. A candlestick formation is a group of these candlesticks coming together to give us a message. All right, we're going to explore all the major ones here right now. So beginning with the bullish candlestick formations. The first one is what's known as a bullish engulfing candle. The first one is known as the bullish engulfing candlestick formation. Now, the bullish engulfing candle occurs when the bulls take back control from the bears. Okay, and the formation is comprised of a minimum of two candles, where the second, the most recent candle, engulfs the first by more than 50%. And so that's the key with a bullish engulfing. It has to engulf the first candle by more than 50%. Okay, so in other words, it kind of has to be more than double the size of the candle it's engulfing to be considered a bullish engulfing candle. The next one up is a Morningstar. Now, a Morningstar is comprised of a minimum of three candles. A decisive bearish, okay, decisive bearish candle. So in this example, right, we're in this graphic here, price is starting here. This is the starting point for price. The bears pushed this down significantly and managed to close it at a price point that is substantially lower than where price is open. So that, you know, that makes this a decisive bearish candle. And then that's followed by an indecisive candle. And this can be bullish or bearish. It's kind of irrelevant here. The point is it just has to be indecisive. So you have decisiveness, followed by a bit of indecision, followed by and concluding with a decisive bullish candle. So this is where you can visually see that the bulls have retaken control from the bears and are now actively pushing price higher. Okay, and with a Morningstar, it closes with this engulfing bull. Okay, so where price began here, dropped to this low point of the formation, but then rallied again to end essentially, more or less where it started off. Okay, it's a U-turn signal. You can almost see the U as well. Okay, and it's called a Morningstar because the sun rises in the morning, and so we call it a Morningstar to help us remember that the appearance of this formation is an indication that the markets are about to rise. Much like the sun in the morning, right? The markets are about to rise, hence Morningstar. Okay, so once again, a Morningstar is a sign that the bulls are trying to take back control from the bears. Now, as with most things, when we find these occurring on the larger time frames, okay, the chances of this being the case, where the bulls have indeed or are indeed taking back control from the bears, right? Those chances become substantially higher than when we find these occurring on a smaller time frame. Okay, so put another way, and this is true for pretty much everything across the board. Put another way, the higher the time frame, the more reliable the formation, the more reliable the signal. Okay. Next up is the hammer. Now the hammer is a one candle pattern indicating a potential reversal. Okay. The candle opens with sellers in control, but buyers fight it out to drive prices higher than the open by the time the candle closes, which is why a long wick will appear to the south. Again, remember the anatomy of a candle, right? We have four components to every candle: an open price, a closed price, a high, and a low. With a hammer, the high also happens to be the closed price. Okay, the low is going to be much lower, significantly lower, and that's how you know the bears were trying to drive price down, but the bulls were putting up a fight and driving prices back up again. Okay, and then where the candle closes, of course, is going to be higher than where it opened. So if we're looking at this in terms of a sequence of events, right, prices opened here. At some point, the market drove prices all the way down to here, but then the bulls came back and fought back and pushed this right back up again. Okay, not just to the point of the open price, but beyond the open price, to leave behind a bullish body. That's how we get this bullish body here. That's why we get this bullish body here. Okay, and then where the bulls close it out, they close it above where prices opened. And so that's how we know this is a bullish formation. If you break it down into sort of that sequence of events, it helps you to see this a little bit better. Or hopefully it helps you to see this a little bit better. Okay, and so this is what's known as a hammer, and so called literally because it looks like a hammer. Okay, there's no other clever explanation for that. It looks like a hammer, and so it's called a hammer. Hammers are tradable on their own or in conjunction with other technical factors and indicators. Okay, next up is the tweezer bottom. And tweezer bottoms are like two hammers that happen in succession. In order to be considered a tweezer bottom, the formation must meet the following criteria. There must be two candlesticks which touch the same low or similar low within a few pips here and there, okay? But the point there being same or very similar. Two candlesticks which touch the same or very similar low and get rejected, driving prices higher by the close. And again, closing with price above the open price on not one occasion, but two occasions. So it's double confirmation that the bulls have taken back control and pushed price higher enough to push it beyond the open beyond the open price and close it beyond the open price, leaving behind the bullish bodies. Okay, the wick, this is very, very important. In fact, this is probably the most defining characteristic of a tweezer bottom and their bearish countertop, their bearish counterpart, the tweezer top, which we'll cover in a moment. But the most identifying, or the strongest identifying criteria, is that the wick must make up 60% or more of the entirety of the candle. So between the body of the candle and the wick of the candle, between the body of the candle and the wick of the candle, the wick must be, what's greater here. Okay, the wick has to be bigger than the body for both candles in order for this to be considered tweezer bottoms. And finally, the third criteria is that the low which has been tested does not get taken out. And when I say taken out, I'm going to add a little caveat to that, a little asterisk to that. Taken out by a large margin. Again, this doesn't have to be exactly the same low, but the same or very similar low is what we're in fact looking for here. And that is a tweezer bottom. Next up is the harami, the bullish harami. Now a harami is a two candle formation which indicates a pause in the market's momentum. Unlike the other formations we've already studied, a harami is indecisive, meaning when it happens it does not necessarily indicate a change in direction. We do not advise using this formation to enter into a trade, but seeing this appear whilst you're actively in a position will help you to make better decisions for managing your position. So for example, if you're in a position in which you're significantly in the black, or another way of saying that is you're significantly in profit, okay? When a harami appears, you might consider tightening your stop, or if you've already locked in profit, you might consider locking in some more, as the market is telling you that the momentum is ending or has ended. That's what we're seeing when we see a harami appear. And let's understand, again, the procession of things here, the order of events, in order to understand why that's the message that's being delivered by the markets here, okay? If we take a look at just these two candles, all right, the open price is going to be up here, the top of the body of this bearish, decisive bearish candle, okay? The top of the body there is our open price. So this is where price began. At some point over the period of time, whatever period of time that this particular candle happens to be measuring, for argument's sake, let's say it's a 1 hour time frame. Okay, so over this hour, or I should say over these 2 hours, because it's a two candle formation. So over these 2 hours, okay, price started here, at some point rallied up ever so slightly, so went above the open price, but then was driven down aggressively, okay, and definitively by the bears all the way to this low point. Then the bulls started to come back, started to give a little bit of a fight, okay, and push this back up and closed it here. So this is our close price. All right, so just to recap this first hour of the 2 hours here, right? Prices started here, at some point rallied to here, at some point dipped to here, but ultimately closed right here, okay? Then the very next candle, what actually is our harami, okay, same open price, right? That doesn't change unless there's a gap, right? But same open price here. So, where this closed is where this opens, okay? And again, look at the progression here. Look at the series of events, all right? This is the close price. So price in hour number 2 opens here. At some point is driven down to this low here. but then the bulls show they're still in control. They show they're still in control. They're fighting. Okay, they're driving prices higher up to this point, the high price. But then the bears come back in at the end, just enough to push this down and leave a wick behind. Okay, so again, if we're just looking at this in terms of the series of events, okay, if prices start here, at some point end up here, close here, reopen here, okay, you get a bit of fluctuation again, but then prices close higher than where they opened, immediately following a decisive bearish candle like that. Well, what we're seeing is the market stalling, right? This is a sign that momentum for the bears either has ended already or is potentially ending. Now, again, a harami, unlike the other formations that we're covering here, a harami is indecisive. So it doesn't necessarily indicate a change in direction, necessarily, right? But it does certainly indicate a pause or a slowing down in momentum. Next up is a piercing line. Now, a piercing line is a 2-candle reversal pattern which begins with the sellers in control. Okay, and we can consider a formation a piercing line when A, the sellers are in control, then B, the bulls take back control by pushing prices higher, and C, the bullish candle closes beyond the 50% point of the previous candle. Okay, so again, look at the series of events here to understand this better. Okay, if this is our open price, we see the bears were very much in control and drove price down, closed it here. The very next candle, okay, bulls opened up here, so they opened up at the close price, as they would. At some point over this period of time, the bears managed to, retain their control and push this down ever so slightly further. But ultimately, the bulls came right back in and aggressively pushed this up. And if the bulls happen to come back in here and push this up beyond the 50% mark of the previous candle, so in other words, if we've U-turned here and the U-turn goes beyond 50% of this preceding candle, well, ladies and gentlemen, we have ourselves a piercing line, okay? And if we see a piercing line, it's a sign that the market is likely about to start moving in the opposite direction. We can directly trade piercing lines, and we can use them for management of existing positions. Then we have the doji. Now, the doji is a 1-candle formation indicating a potential reversal. It's a signal from the market that tells us the current trend may very well not continue. So again, just like the harami, it's another indecisive formation. Okay, so it's another sign that momentum is slowing. Now, this doesn't apply to the overall trend exclusively. In fact, any of the formations which appear in the market can also be a sign of short-term reversal within the bounds of the larger overall trend. For example, if we're in an uptrend but the market has been selling off as part of its natural retracement, then one of these appears. It could present as a good indicator that the market is ready to stop retracing and start extending. We'll learn about these retracements and extensions, including how to use them to our advantage in our lesson on Fibonacci retracements and extensions later in the course. Now let's look at our bearish candlestick formations. Okay, so beginning with the bearish engulfing. Just like we had a bullish engulfing, we also have a bearish engulfing. And bearish engulfing candle occurs when the bears take back control from the bulls. And the formation is comprised of a minimum of 2 candles, where the second, most recent candle engulfs the first, again, by more than 50%. That's the key there. Okay, it has to, essentially what we're saying, again, to reiterate, is that the candle essentially has to be double that of the previous candle. So in other words, it has to engulf by more than 50% in order to be considered a bearish engulfing candle. Next up is the evening star. An evening star is comprised of a minimum of 3 candles, a decisive bullish, followed by an indecisive candle, again, bearish or bullish is irrelevant, and concluding with a decisive bearish candle which moves beyond the 50% mark of the body of the first candle. Okay, so again, clearly showing us an indication of a U-turn here. Okay, now we call this an evening star, again, using the same naming convention as its bullish counterpart, the Morningstar. All right, we call it an evening star because the sun sets in the evening. Right, so you picture Morningstar as the sun rising. Okay, the sun's rising in the morning and setting in the evening. So if we see an evening star, it's an indication that the bears are going to start taking back control here and driving prices further downward. That's why it's a bearish formation. Next up is a shooting star, which is the bearish counterpart to the hammer formation. So exactly the same as the hammer formation, the difference here being that rather than a bullish formation, it's bearish. So rather than the body of the candle being up at the top of the wick, with a shooting star, the body of the candle appears at the bottom of the wick. Okay. Now the candle opens with buyers in control, but sellers fight it out to drive prices lower than the open by the time the candle closes. And so again, looking at the procession of events here, okay, here's our open price, here's our high price all the way up here. But you can see, you know, we touched that price, but then the bears came right back in and drove this right back down again to close it out beyond where it opened, okay, below where it opened, all right, which makes it the bearish candle that it is, okay. And if we have this long wick being left behind to the north like that, well, then that is an indication that this is a shooting star. Okay, and just like its bullish counterpart, the hammer, shooting stars are tradable on their own or in conjunction with other technical factors and indicators as well. Next up, we're looking at tweezer tops. The tweezer tops are like 2 shooting stars that happen in succession. So just like the tweezer bottoms, which are the bullish counterpart to these, okay, tweezer tops are like 2 shooting stars happening back to back. Okay, in order to be considered a tweezer top, the formation must meet the following criteria. And again, the criteria is exactly the same and exactly the opposite of its bullish counterpart, in that the first bit of criteria here is that the 2 candlesticks which touch the same high and get rejected drive the prices lower by the time the candles close. Okay, the second criteria is that the wick must make up 60% or more of the entirety of the candle. So if this is the whole candle, if we're looking at wick and body combined, and this is the whole candle, then the wick making up 60% or more just means that there, another way of saying that is that there really needs to be more wick than there is body, significantly more wick than there is body. Okay, and the third and final criteria is that the high which has been tested does not get taken out. And again, just like with the bullish counterpart, the tweezer bottoms, I'm going to add a little caveat there, a little asterisk to say, as long as the high tested doesn't get taken out by a significant margin. You can have a slight difference here, a couple of pips here and there, depending on the time frame as well. The higher the time frame, the more sort of slack there is, if you like. Okay, but ultimately, that high that's been tested cannot be taken out, not by any sort of meaningful or substantial margin. Next up is the bearish harami. Okay, and just like its bullish counterpart, the bearish harami is also a two-candle formation. It also indicates a pause in the market's momentum. Okay, so it is not a decisive formation in that it's not going to communicate to us decisively a directional move. Really what it's trying to communicate to us more is that there's a pause in the existing move. There's a pause in momentum. Okay, so again, you know, if we're in a position already where we're significantly in the black or significantly in profit when a harami appears, then we can consider tightening our stop or moving the stop to lock in profit. Or if we've already locked in some profit, we could consider locking in some more. Okay, all of it, you know, consider all of it to be sort of like emergency preparations. So a harami is like an emergency signal. Okay, it's saying, hey, trader, you know, the momentum just isn't really there anymore. It's starting to die off. So be careful. Okay, that's what I want you to think of when you look at haramis. That's what I want you to sort of relate it to help you understand it better. Okay. We talked about the piercing line before, which was the bullish formation. Now we're going to talk about its bearish counterpart, which is called the dark cloud cover. Okay, so just like its bullish counterpart, the piercing line, dark cloud cover is a two-candle reversal pattern which begins with buyers in control. Buyers are in control, and then the sellers take back control, pushing prices lower. And if the bearish candle closes beyond the 50% point of the previous bullish candle, then that's when we can consider this to be a dark cloud cover formation. Okay, and when we see a dark cloud cover, you know, just like its piercing line counterpart, it's a sign that the market is likely to start moving in the opposite direction as the counterparty has taken control. So in this case, the bears have taken control from the bulls and have pushed price down so that it closed beyond the 50% mark of that previous candle. Okay, we can directly trade dark cloud cover formations, and we can also use them for management of existing positions. We can also use them, you know, in conjunction with a few other indicators and tools to make trading and entry decisions. Next up is the doji. Again, just like the bullish doji, there really is not that much of a difference in terms of bullish and bearish doji, other than, technically speaking, a bearish doji, you know, just like all bearish formations or all bearish candlesticks, really, a bearish doji drives prices lower so that they close lower than where they opened. Okay, but if it's a doji, then it wouldn't have been by a significant amount. And again, you know, here with the dojis, there's more wick than there is body, because there's a lot more indecisiveness than there is decisiveness. And that's what accounts for that long wick, small body. Okay. And we're going to end our lesson on Japanese candlestick formations with the neutral candlestick formation I like to call the spinning top. Okay. Spinning tops create boundaries. The top of a spinning top boundary, so the top of the wick here, is resistance, the bottom is support. And that's true whether, you know, this is a bullish or bearish spinning top, it doesn't matter. The top of the boundary, or the high here, is the resistance, the low is the support. Okay, and a spinning top, so called because it looks a bit like a spinning top, okay, will have a recognizable body in the center Okay, but the high and the low price are so far from the open and close that you can kind of see the spike. You can see where the market spiked and came back again. But ultimately, you know, prices were pushed higher to achieve this high. Prices were pushed lower to achieve this low. But ultimately, it closed right here in the middle. And so that is an indication of indecisiveness. And that's why we then set this up as a boundary. And if we find these spinning tops on the large time frames, then the boundaries they create translate into tradable range-bound boundaries on the lower time frames. And we'll explore that in due course. Okay, but these are tradable opportunities that present themselves with spinning tops when we see spinning tops occurring in the market. And of course, you know, the higher the time frame, the more, not only the more reliable the spinning top, but the bigger opportunity that can be found as a result of the spinning top and how the market is interacting with its boundary on the smaller time frames. Okay, that wraps up the theory portion of our lesson on Japanese candlestick formations. But now we're going to actually go and turn to the live markets to find some examples of these formations and see how the market reacts when each one forms.